Now, on the economic growth note, analysts at Genghis Capital project Kenya's real GDP to grow by between 5.25 and 5.75% in 2018, and that's up from about 4.7% in the first 3 quarters of 2017. Now, the details are contained in the Genghis Playbook 2018, which was launched earlier on Tuesday. The group says that growth will be supported by a rebound in both public and private investment, positive performance in the agricultural sector, and a continued rebound in the service sectors. Similarly, heightened focus on food security, affordable housing, manufacturing, and healthcare will positively contribute to the country's economic growth. Well, joining me in the studio to break down Kenya's economic outlook and certainly its debt sustainability is Churchill Ogutu. He is a senior economic analyst at Genghis Capital Investment Bank. You're very welcome to the show, Churchill. Well, your report that you released, you certainly forecast GDP growth will quite positive compared to other analysts that have forecast about 5%. I saw Standard Chartered forecast about 4.7%, the same as last year, the same period last year. They point to a credit crunch, reduced public spending as well. What do you guys think will drive growth this year? Tell us a little bit more about that.
Thank you, Uche. Some of the factors that we're looking will be able to drive growth in this year. One of them is a rebound in the public and private investment. Looking at last year, there was a protracted electioneering period. Definitely that had an impact on even the private business sentiment. You can look at the data PMI, which tracks the private sector, goods of the private sector business activities. Basically, between the month of May to month of November, it was below 50, which is showing a contraction activities. So, I mean, this year, with elections behind us, the unease in the political risk, we're definitely likely to see a rebound in the private investment. Bearing also in mind that private sector consumption accounts for around 80% of the total GDP. So that's definitely something that we'll be able to see in the course of this year. And also with the backdrop of the elections, we're also likely to see public investment also rebound. I mean, some of the infrastructural developments that were on course last year had to halt because of the elections, and also a slow absorption of funds also in development expenditure sort of had a curtailed development in the public investment. So we're likely to see the same is in the course of this year. Another issue is about agricultural sector. It accounts for 25% of the overall GDP in our economy. There's a bit of the first quarter period, there's a drought impact which negatively impacted this huge sector in the economy. Likely our outlook is we've seen a bit of some improvement in the weather condition, and also the focus in the food security being one of the 4 key planks under the big 4 items. We're likely to see much more forays into this sector. Lastly, also the continuation of some of service sectors, talking about tourism numbers. Last year, despite being an electioneering year, we saw that the tourism earnings actually surpassed at 120 billion shillings, that $1.2 billion. I mean, over what we saw in 2016. So that was a positive, and also information and communication sector. Nevertheless, we have some risks within this global the growth outlook. One of them is credit crunch, as highlighted some of the analysts, and also another one is a focus into the recurrent expenditure. 46% of the national government spending is into recurrent expenditure, and just a paltry 17% into development spending.
And just to delve further into that, how do you figure that interest rate caps are going to impact on business activities and certainly private sector growth going forward?
Basically, financing is one of the major issues that even the businesses they look at. But you've seen that the private sector credit growth last year, it averaged 2.33% from 9.28% that was there in 2016. This was basically, the decline was basically on account of the banking amendment law, which you've seen that most of the banks have shied off lending to customers, to businesses, which has brought about the low private sector credit growth that we've seen in over last year. However, the feeling is, even looking at what MPC has been coming, there's been a feeling that they want to do away with this banking amendment law. You also see that even the language from the MPC statements is like they keenly monitoring the impact of the interest rate law into the economy. So it's quite a concern even to them. So my feeling is, unless there's a review or a repeal of the interest rate law, we're likely to see the private sector credit growth still subdued at these levels between 2% to 4%, which will curtail growth to an extent. Yeah.
Now, looking closer at the economy, we know Moody's recently downgraded Kenya's debt from B1 to B2 over its rising debt profile. We know the IMF has now withdrawn. In fact, we just found out the IMF has withdrawn its permission, of course, for Kenya to tap that standby loan facility, and that was back in June. And it mentioned the fact that Kenya's high fiscal deficits and certainly its growing debt profile, huge concern. So what are your thoughts on the fear that Kenya may struggle to pay its repay its debt, given the fact that we're seeing the government below a target when it comes to revenue collection?
Sure, debt levels is quite a concern. Right now we are looking at 56% heading to 60% as at June of this year. That's the public debt ratio over the GDP. It's quite a concern even to the IMF and also the credit agencies, hence which led to the downgrade that we saw from B1 to B2. On another hand, also in addition to that, IMF has been quite keen on fiscal consolidation. Their target for this current financial year was 3.7%. What the government is actually targeting is 7.2%. So there's a bit of a worry that, well, we're not adhering to austerity measures, which will now be able to at least help us to get into the path of fiscal consolidation. That's one of the things actually that led to the withdrawal of the precautionary facility at CBK, the $1.5 billion. I mean, it's something that even MPC has not, CBK has not put public up to now. I mean, 7 months down the line is quite a concern.
Yes, it
but
is.
CBK, in my view, is really quite cagey in terms of revealing some of the information, even in terms of the dollar sales that they do occasionally. It's quite cagey on the quantum that is done. So it's not a surprise coming from them that they are really been shied away from it. Nevertheless, it's quite a concern even to international market that IMF has denied access to this precautionary facility, in as much as you may not use it as a country, because it's basically there to curb against exogenous shocks in the economy. We may not use it, but it sends a signal that we are prepared in case of any adverse impact of the on the currency. So it's quite negative.
So that does that impact your outlook in any way?
Yeah, it's quite shocking because it was quite out of what we expected.
Right.
Looking at my expectation is CBK was able to meet the targets that had been set by IMF as at December. That's the net international reserve flow, $7.5 billion, and also the net domestic asset ceiling, that's around negative $2.8 billion. But I mean, right now, actually that credibility has been quite dented, coming from what you've seen today.
Well, I'd love to keep chatting about this, but we have to go. But many thanks for joining us in the studio. Of course, that was Churchill Ogutu. He's with Genghis Capital Investment Bank.